Good morning, everyone. This is Marshall Giller bringing you the morning comment for March 9th. Well, Friday's better-than-expected U.S. employment data brought forward expectations of Fed tightening and kept the dollar rally going. The market could explain away a weaker-than-expected number, but there is no getting around such a strong one. Given the importance of the labor data for the Fed, that's what's moving the market. European indicators are consistently beating expectations, while U.S. indicators, aside from employment, are consistently missing expectations. But the dollar continues to rise and the euro continues to fall because expectations about central bank policy are what's moving the market. The report virtually sealed the case for a Fed rate hike this year, unless there's a big change in circumstances. Longer-dated Fed funds futures rate expectations jumped 15 basis points, and three regional Fed presidents called for a rate hike. Two called for one around the middle of the year, and one even said he'd vote for a rate hike this month. Contrast that with the 21 central banks globally that have loosened policy so far this year, and you can easily understand why the dollar gained against virtually all the currencies we track, except for the ruble, and, in my opinion, could rally further. Now, commodities were hit by the combination of a stronger dollar and higher U.S. interest rates. Gold and silver were down, oil collapsed, and copper fell too, as China's copper imports plunged. It's no surprise then that Norwegian krone and New Zealand dollar were the worst performing G10 currencies from Friday morning, with the Australian dollar not far behind. It lagged only behind the euro. Today, there aren't such big indicators coming out. The Swiss National Bank will release its weekly sight deposits, which could reveal if the bank intervened in the FX market in the week ended March 6th. Deposits rose only slightly in the previous week as Euro-Swiss kept fairly stable. From Canada, we get housing starts for February. And the U.S. releases the Labor Market Conditions Index for February. This is a monthly index that draws on a range of data to produce a single measure to gauge whether the labor market is, on the whole, improving. No forecast is available for the number. Perhaps, though, the key point today will be talks by Minneapolis Fed President Kocherlakota and Cleveland Fed President Mester. Kocherlakota is a well-known dove who argued last month that the Fed shouldn't raise rates this year. If even he is now arguing in favor of tightening, which we don't know yet, then it's pretty much a done deal. As for the rest of the week, tomorrow in the Asian morning, we get China's CPI and PPI data for February. On Wednesday, the spotlight will be on the Reserve Bank of New Zealand policy meeting. And, of course, during the week, we'll be on waiting for any news about Greece. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.